and welcome to More Than Commas. I'm your host, Paul Adams. This is episode 318. This is our final piece of our four-part series where we're looking at the white coat investors' critique of the Ernst Young white paper so that you can better understand financial writers, their opinions, and how to make them make sense on your balance sheet. No discussion of canceling term insurance. Liar. Liar. And here's what I'm going to show you guys. Okay. I saw this. No discussion of canceling. Now, this is what he's telling his audience. Obviously, the cost of term life insurance at age 85 is going to eat up a lot of retirement income. He's saying that they put the term insurance on the investments, and that's what's crushing the investments and taking away all the return. And that's why this freaking whole life is doing so well. I think that's pretty much exactly what it wrote here. I think I quoted that. Right. For those of you just audio on the podcast, probably I didn't quote that right. So, but a major problem with these studies, they assume, this is what he wrote, that a person who buys the term and invests the difference keeps that term life policy until they're 80 and 90. By the way, I've been reading these studies, Corey, for 27 years. I have not read a single study yet that made an assumption that you would keep term insurance until age 85.
Where does it say that in the study? I don't remember.
That's right. It doesn't. That's why I yelled liar. Corey, it's only up here on the third page, right in the 5 strategies. Under this approach, the investor purchases annual renewable term insurance,
until
legacy protection until age 65. He just told his audience they don't say anything about it and then assumed the worst. Here is the thing for everybody listening to this. This does not mean this guy is a bad person. It doesn't mean he's not smart. It doesn't mean any of those things. And usually when you find problems with people, if some of our white coat investor fans are here today, you are going to hate on me and Corey. More on me than Corey, but that's just how we're genetically predisposed.
That's how it usually is.
But in this case, he is out and out saying something that is not true about this. And then making a statement, that's why the investments don't look better. So again, it doesn't show he's a bad guy, but when you see, like many of these things we've just seen, it doesn't even mean it's no value. What it is he's making an assessment, and he's walking you through what he thinks is grounding for that assessment about how you should relate to whole life insurance.
This is like literally on the first couple pages of the study, it handles this problem that he has. So he missed it entirely. He missed it entirely, either willfully or not, and made a blanket statement that ends up being an untrue statement. And frankly, that's why I try to avoid making blanket judgments like that entirely, because I don't know what I've missed. I can comment on, here's the thing I'm talking about, on whether this works or not, but we don't even ever say that whole life is good for everybody always. We don't say that most things are bad for anyone always that we don't like, because we don't want to lead people in the wrong direction. And we don't know everything. We just know the best that we know right now. He's saying that he knows everything, and that's frustrating for me to deal with as someone who had to get a lot of licenses and go through a bunch of hoops to give good advice.
What we're learning when we see this, when we see an out and out, totally unfactual statement, he is saying the study doesn't do this, and therefore that's why the investments aren't as good. What you can see is an underlying assumption that anything that has an annuity or whole life can't possibly outperform, and he is inventing information, giving it to you as fact as a reader to get to that conclusion. By the way, this is not something unique to just this particular guy writing about finance. This is the case for nearly every person writing about finance and why you need to be this rigorous. So it doesn't mean he's a bad person. Doesn't mean he doesn't have good audience. Doesn't mean he doesn't say some good things a lot of the times. What it does mean is you cannot trust his assessment on life insurance, because he's proven that he's willing to make assertions that can be proven factually wrong, loudly declare them, and then in the comments, watch him defend those. So that's the key. We just can't trust the assessment anymore of the author. Doesn't mean there isn't good information in the article. Just means you can't trust the assessment. You have to make your own assessment. Okay, Corey.
Paul, they're using industry representative policies. And this is another reason why it can't be true. There is not term insurance at 85, like just true standalone term insurance. I have seen. I haven't seen one.
Then you would have to get, well, I guess he's right, if because they do now, right next to it, it said when they said it canceled at 65 is the other information that he did use, which is its annual renewable term insurance.
So I guess
Cancel it at age
yes,
65.
theoretically you can keep a policy that expires at 65 past that point, but you'll see in an illustration it goes from $1,000 a year to $12,000 a year, and more and more and more.
Oh
Like
yeah.
no
And at
one's
age 85, you're paying like 70% of the death benefit year 85.
right,
Forgetting the fact that you already paid more than the death benefit up until that point. Like it's a
right.
ridiculous thing for him to say, and shows total naivete about even the pricing of annual renewable term insurance
Mm,
and to the white paper itself. I think this guy read this, let's say, while sitting alone in a small room on a chair that sits a little lower and is a little harder than most people are comfortable with. And once he was done with that activity, that's all the more he invested in reading this paper. Okay. His next one, Corey, whole life beats bonds. We have now gone from ridiculous to
right.
outlandish. They make the outlandish claim that whole life insurance performance beats bonds. That's not actually true. If you look back at the golden age, now, okay, that's not actually true. So now you're going to give me some facts. Great. If you look back at the golden age of whole life insurance policies bought in the early 1980s, when interest rates were sky high, people had returned 7-8% on their policies. True. But 30-year bond treasuries bought back in the early 1980s were yielding 11 to 14. Also true. Even in 1994, you could still buy an 8% 30-year treasury bond. Whole life didn't outperform bonds, and it still doesn't, especially in the first decade when they have negative returns. They just expect you to believe them when it does. Now, by the way, you're telling me bonds outperform whole life, and you have not given me any information as yet, just like you accused them of not giving you the
Right.
information. Okay. Participating insurance products. So these are, they even try to explain why. He's saying in his paper, number one, participating insurance products tend to outperform fixed income because mutual life insurance companies and institutional investors have access to asset classes that individual investors do not. This is a lie. Look at the portfolios of insurance companies. They're mostly filled with the same old boring Vanguard bond funds you buy on your behalf. The vast majority of what they buy, you can too, without any issue at all, and avoid losing their cut of return. Not not a liar, but wildly, wildly wrong. Because what here's the thing, and he's just misleading you because he can actually be saying the truth, which is it says a lie. Look at the portfolios. They're mostly filled with the same boring old Vanguard bonds. So mostly is, as a definition, what percentage?
Right.
More than half.
Right.
Okay, so maybe now it's not boring Vanguard funds. They're owning bonds directly. These large institutions, they're not buying a street level Vanguard fund. And the vast
So
majority of
mostly,
what they
so he's
own,
actually conflicting with himself, right? Like, and there's not a source. He's saying go look at it, but not citing a source to say here's one and what it is. Um,
yep.
that's kind of
And
all of these are
yep. And these
similar
companies have
theme.
professionals managing their assets, which provide value for fixed income. Not true. Index funds outperformed managed funds, even in fixed income. There's a difference between a retail managed fund, Dr. Dahl, and an insurance company that goes direct to a city government and takes down $1 billion of the bonds with no intermediary. Like that is a very different investment.
Yeah.
So they do tend to outperform. Whole life tends to provide superior returns over fixed income in long run scenarios due to the combined effect of guaranteed growth of cash value and dividends. Not that's no, that's not really true either. As we discussed above with the best whole life policies ever sold, I have no idea what he's talking about there. And
Yeah, I don't
the
know
best
where he
whole life,
discussed
oh,
that.
maybe best whole life policies ever sold. He's talking about the bonds
The 80s. Oh, the
versus
80s
the
when they
80s.
were 11. Yeah.
Yeah. Which, by the way, objectively, if you had any study of the insurance industry, those 80s were a horrible time for insurance because what ended up happening is a bunch of clients said, I want to put in the least I can So rather than maximizing the amount they get in that tax exempt environment, they instead said, what's the least I can get the insurance for? And then those policies piddled out when the interest rates went down. Using whole life, okay. Number 4, he's saying these are their justifications, which, by the way, so far, all true. And superior returns over fixed income, like we can prove that. We have proven that, and especially after tax. Using whole life.
Well, he's not talking about the after tax. He's not talking about the fact that bonds can fluctuate in value. So if you're withdrawing money at any time, we have to think about the relative time in the cycle of the bond. He's not talking about the value of the cash value at death, the death benefit of the life insurance that would also be a part of the long-term rate of return. So next.
Yep.
This episode is brought to you by Sound Financial Group. At Sound Financial, we specialize in helping clients build strong, long-term financial strategies for their retirement. If you're looking for personalized advice to help manage your wealth, visit us at sfgway.com to learn more about how we can help you achieve your goals.
And then here's one of my favorites. We've done episodes on this. We're getting ready to do another one in the next few episodes. Using whole life as a volatility buffer improves returns because the investor does not have to sell and realize losses on their investments. During market downturns, you can sell appreciated bonds instead of temporarily decreased stocks just as easily as you can borrow against whole life. But does he have a special bond fund, Corey, that doesn't move with the market at all? It's just a book value asset, never decreases, I guess.
Right. No.
Because what he's
not always appreciated. Yeah.
So, and then he's saying percentage of the funds that underperform their respective benchmarks or overperformed. Oh, so I think what he's saying here is he's trying to say remember earlier he was saying like, oh, the insurance companies can't be outperforming fixed income because actively managed mutual funds don't outperform fixed income. True, by the way, he's totally right about that. And then
he's right about that, yeah.
He's giving us a bunch of funds. Like, listen, if you're in his audience, sorry. And what I mean by sorry is like, if you're hearing this and you read this article, like, I know he made this look compelling, but he's literally comparing a retail mutual fund that you could put $1,000 into to governments, or not governments, huge international insurance companies deploying billions at a time. Like, you can't own a Manhattan apartment building. These insurance companies do. And that's like a bond type asset that's just cranking out rents to them.
Right.
You can't do that. It's just objectively false. Okay. Now, this is one of my favorites. So let me read this to all of you. Number 17 is his problem is there's no discussion because while the study looks at deferred income annuities, it doesn't talk about single premium immediate annuities. And he says, want guaranteed income in retirement? Buy a single premium immediate annuity. No reason to buy a deferred income annuity at age 55 if you're not going to start spending for another decade or more. Better to leave that money in a higher returning investment until you need to start getting guaranteed income. Want to solve for the highest possible income? Invest aggressively until 70 and then put all that money into SPIAs. You'll have dramatically more money to spend. And number one, it is amazing to me that this is the problem he has and no demonstration of whether or not them waiting to buy SPIAs would outperform. Because Corey, you and I've recently done some clients where there is that window, and for the properly structured contract, it's because if we got 5 or 10 years, that could be 5 or 10 years of not great equity markets, and we can trade that to get basically an average from the insurance company with a guaranteed income at 65.
Right. Look, SPIAs can be very effective, and we got no problem with SPIAs and are willing to use them in the right case. But that client at 55, it has to work out well to get to 70 to have the right amount of money to put in the SPIA. That's where the deferred income annuity can take some of that edge off. So it's not really, it's like solve for the highest possible income when everything is working out the best. It's not taking into account the real experience of someone sitting at 55 facing an unknown future and how we can take some of that risk off the table for them. Yeah. All right.
All right, big finale, Corey. Number 18 is going to take me a minute, but it's called no significant difference, is what he says. So this is his 18th problem. After all the other feelings he had, this is the 18th one. Despite all the advantage given insurance products in the study, if you look at the results, they all look the same. Now, pause. See, this is what agitates him. He thinks that his should be way better. Now, he didn't go back and do the math or find out any of the assumptions, put in his own spreadsheet and say, okay, guys, watch this video where I walk through it. By the way, we are going to do that in another couple episodes.
Cool.
So, amazingly, the less you spend on insurance products, the less money you ended up with. But if you think your life is significantly better and worth dealing with the hassle of not one, but two complicated insurance products for 70 years or an extra $400 a month, I've got a bridge to sell you. I can't believe with all the help they gave the insurance products in that study, all disproven as we went through this. Couple little things we agreed, but the study wasn't disproven. We just agreed with other opinions that this guy had generally about finance. I mean, look at the effect of that 1.25% advisory fee alone on the 16K this couple invested per year for 40 years. It's a $1.6 million difference. That's $65K a year in additional retirement spendings. And we're bragging about winning by $5K a year. Now, in the study, the $5K increase is on $66K of income by what he's saying right here. That's not a little increase, y'all. That's a 9% increase in income for the rest of your life. And you took less risk because we didn't have as much in equities or market impacted fixed income.
Well, and never mind that the range of legacy at the end of the horizon is 300 million, 3 million at the lowest, 3.6 million at the highest, $600,000 extra on 3 million. That's significant.
Which could mean you just chose to spend more. Maybe you chose to give more.
Could
but you could have more life with that energy. The difference in their study is not significant, but you wouldn't know unless you combed through the results with a fine-tooth comb. You wouldn't know unless you went through with a fine-tooth comb. Show me the comb, doctor. I guarantee it's not one to get lice out of a kid's head. I think it's more like, I don't know, like the comb of a rooster. Is it spelled the same? I think that's what he thinks a comb is, because all he did is take a rooster's little flappy bit on top of his head and like smack it against the paper. That's what he must mean by a
this is where we got to. I think.
Yeah, I'm sorry. Guys, this has been a bad one for me. Like, do you know how much intellectual energy it's taken from me to not curse during this episode, during some of what we've exposed? The bottom line is the EY brochure is not a study at all and should not enter in your consideration of buying whole life insurance or an annuity at all. If you need or want whole life insurance and truly understand how it works, unlike me, the author of this article, then go buy some. Same with annuities. But don't let an insurance company funded study convince you you are likely to come out ahead of buying term and investing the rest approach. This, he must think, I guess he does. He thinks people read or listen and then just go do the thing. Because I guess that's what he offers. As opposed to sitting with somebody, doing the math, weighing considerations, discussing it with your spouse, and then making a decision that's right for you and your family. So he's thinking people are going to go act because of the study, as opposed to all it's meant to do is to crack people open from the closed-minded, overly biased situation that Dr. James Dolly is in here. Whatever. White coat investor. He's stuck in this and he can't get out of it. And if you're reading his content, the Ernst Young thing that Corey went through last episode in the white paper that you can download is designed to offer significant mathematical grounding and scholarship in the face of opinions and zero grounding, as demonstrated here. Corey, with your permission, well, not with your permission, I'm going to run out and find more of these articles to talk to you about. And then with your permission, we will publish them.
I like it.
We might have to have a few we just put in the safe and just never release them just to get it out of our system. But what the big point here, guys, is not that this guy didn't make good points. If you had read this article and said, you know what, this white paper, and said, maybe whole life insurance could be a good idea. I should look at the math. I would encourage you to read an article like White Coat Investors, ask those questions. And if your advisor could not answer the questions like we could now, then you shouldn't do life insurance. Because if they don't know more about the insurance than this guy does, and not by being mean or whatever, but can just intellectually answer each of his concerns and prove to you, like we just did, that's how you make good decisions and assessments. You get a strategy or you get open to a new idea, and you can go look at the opposite side of that idea and see who has the better grounded assessment. Corey, this is the end of this series where we went through every negative thing that Dr. Dahl could find about this episode. It has dominated our airwaves. Anything after this series you want to tell everybody?
I would just echo again what we said before. He has some great points about other things where he could actually ground those assessments, but just like anybody, let's look at the biases and let's actually see through to the data to say, is what they're saying makes sense? Is there strength in that interpretation, or is there weakness? I think that's just important for anything, any article you're reading about anything you're going to do in life, from the next car you should buy to investing to, where you're going to send your kids to school. Same kind of methodology.
Well, and I need to just second that, Corey. And for everybody listening, this is the kind of work it takes to just take a good idea, read, and then actually pull it apart to see if there's anything you want to do with it. We do this with our clients all the time. And so if you clients are out there and you've read something, just flag it. We have clients send stuff to us in between meetings like, hey, can we talk about this article in our next meeting? And we're happy to do it, because what we want to do is help people build the sensibility. Then when we read an article like this, we just read it and go, okay, there's something. Now, if I need to do something with it, we got to really see how they're doing making assessments. In this case, Dr. Dahl gets a failing grade. We'll look at more of his episodes in the future, or more of his articles in the future. But more importantly, what we're going to do is always be working through, do these things work or do they not? And standing on that, in our next episodes, what we're going to be talking about are actual strategies we designed initially with ChatGPT to prove out some of the things discussed in this white paper, and even including some of the critiques from Dr. Dahl of White Coat Investor. Hoo-wee! I can't believe you made it. This is the end of the 4-part series. Listen, if you made it this far, you are doing a great job of learning, bringing new things into your financial life, and improving your balance sheet. I look forward to seeing you next week on episode 319, where we continue this conversation and we look at these strategies actually implemented to see if they can produce the additional outcomes that Ernst Young promised.